Hello everyone, how's it going? In this video, we're going to talk about Opendoor technology. So we'll look into both the bull case as well as the bear case scenario. There's some interesting points to cover here. Firstly, the bull case. Q3 earnings came out yesterday and they're popped up about 17-18% this morning in the pre-market hours. Opendoor is in that iBuying sector, and it's the biggest company out there who's doing this. Basically, algorithms buy these homes, and all these real assets are then flipped. They're renovated, they're refurbished, and then put down back in the market at a better price, and that's what they're thriving on. So the good thing is these are all real value assets. This article is interesting. Basically, Zillow last month, they came out and said they did a mistake by getting into this business. They couldn't predict the right prices because they bought homes, and then right then COVID happened and all these prices became very volatile. Plus the shortage in labor for them to flip the market, renovate the houses. It was getting very difficult for them, and hence they shut down their iBuying business, or they're winding it down, and they laid off about 25% of their workforce. So it was a big setback for Zillow. But at that moment, Opendoor came out and said, "Hey, we've been doing this past 7 years." Zillow just started it, but Opendoor has been doing this for past 7 years, and they understand the market, they understand the financial, they understand the money that's been thrown out. Basically, they know how to buy and how to sell, so they can accurately set the prices of these assets. So that's where Opendoor has that edge in the iBuying sector. The next aspect is these are real assets that the company is owning. So irrespective of what happens with the stock or what happens to the company, they have these assets which are not going away anywhere. And whether the price is depreciate or appreciate, that doesn't matter. But these are real assets that they're working with. These are not softwares. These are not medical devices that could lose their value just because someone decided that these things are not going to work out. Assets are there, and that's very tangible, and they're not going to go anywhere. So that's a very strong case for them. Next, looking at the bear case scenario. First is the valuation. It's sitting at about $19.52, but that's not the price you want to look into. We should be looking into the market range. So basically the whole company is available for us to buy at about $12 billion. So imagine we having $13 billion sitting in our bank account, hard-earned money, very hardly. You took out years and years of hard work to arrange $13 billion for yourself. Now, is this company worth $13 billion? And would you invest $13 billion if you had to buy this company? But looking at the revenue, looking at the amount of revenue that's bringing it up, it's bringing in about 12 billion or 12 to 4 billion, $5 billion annually. And right now in the Q3 earnings, they should put it about 2 billion, a little over north of 2 billion in revenue. The company has not turned profit, that has not turned any positive income. And of course, it's in that sector where they will be losing cash, which is understandable. But is it worth $12 billion for us to invest right at this moment? Now, that's where the margin of safety or that safety principle comes in. Now, imagine this bridge. This bridge is, we know that this bridge is only going to carry vehicles which will be about 10,000 pounds. But when the engineers and the construction people, when they design and manufacture this or construct this bridge, it's being designed to take up a maximum of 30,000 pounds. So even though we know that trucks are going to be used only for 10,000 pounds, we will make the bridge that can carry about 30,000 load. So even though there was any fluctuations in the market, because you and I cannot control the stock price. Today, the market liked it, so it's jumping up. Tomorrow, it may not like it and might drop. So these are fluctuations that you and I cannot control. And that's where the margin of safety comes in, where you want to pay the price very less. So basically, if it's heads, you win. Or if it tails, you don't lose much. So that's the margin of safety you want to look into. And I'll give you a very good example. This is Heritage Growth Properties. And by giving this example, I don't mean for you to go and buy this company, but this is a very interesting example for you to look into. This is a company that holds or owns all the Sears Group properties. So Sears, which are bankrupt, but they had tangible assets, which were the properties. So these are basically the landlords of those properties. And this company has a market cap of about 680 million. Now, the assets or the land or the value or the homes or the buildings that they own, they are about $2.6 billion. So these are assets, live assets. The whole market capitalization is about $2.2 billion. whereas the market cap of the company is only 680 million. So if I had 680 million, and if I bought Heritage Growth Properties and I decided to lay off everyone, shut down the company, break off everything, I have about $2.2 billion worth of land that I can sell and get my money back. That's the power of having that safety of margin. Now let's look into this aspect. This is Data Roma, and it gives the it gives the breakdown of all these super investors that are investing with companies. And Open Technologies has one super investor listed here, Bill Miller. Normally, for these growth stocks, you don't find any super investor put up here. But Bill Miller, on the other hand, he has about 0.01%, which is very less. Now, the next aspect, this caught my interest, and I love the fact that there are 17.89% of insiders that own this company. But the problem here is, well, having insiders being invested into the company gives you that freedom, that gives you that luxury that, hey, the insiders, the people who are running it, also have their interests aligned in the same direction as yours. They have their skin in the game, something you can depend on. But if you look at the institutional or the insider ownership, this is the guy, and this is the only guy available here who's running the company. And Eric Wu is the founder, he's the CEO, and he's running the company along with other 4 friends. And he owns about 32 million shares, which is only 6% of the ownership. The rest, all the other people here are institutional ownerships. The Axis Industries, Coastline Ventures, all these are people who are from the institutions, not Eric Wu, not the founder himself. Next, you have the insider trading that's going on here. These are people, and looking at this, Eric Wu, it's nothing but sale going through. There's one person who's purchasing, and this Pio Kiefer. And if you look at Pio Kiefer is nothing but Axis Industries, and he's basically one of the directors, and he is trying to keep up his portfolio or getting that investment into the company. So he's looking at an investor point of view, not an insider who's running the company. Eric Wu, on the other hand, who's running the company, he's selling it. So think about it. I mean, selling could be for many reasons. Monish Babra explained that if people sell for a variety of reasons, but when they buy only when they feel that a company is trading at a lower cost and it's very undervalued. But you can see there's no buying going on from the insiders, from the owner's perspective. So that's something to keep an eye for. If the owner himself is not investor or doesn't think the price is, or people who's running the company who are very much close to the company, if they don't feel that the price is right there for them to buy, I'm not sure if it's for us to buy. But again, these are my thoughts and just putting it out there. I could be wrong, I could be negative, I could be biased in one direction. Do your own research, think about it from your own perspective. Have a neutral mind, and then do whatever you want to do. With that, take care, stay safe, bye-bye.